Time now for our hot picks. Our next guest is focused on the energy sector and has Keyera as his top pick. He says Keyera is one of the few mainstream Canadian names trading at a discount to its historical average. Here to tell us more is MacNeil, Director of Equity Research at TD Cowen. Aaron, thanks very much for joining us.
Yeah, thanks for having me on, Roger. So as you mentioned, our top pick is Keyera within our Canadian midstream coverage. Industry fundamentals for Keyera are incredibly strong. That's driven by condensate demand locally, as well as a growing West Coast NGL export opportunity. As you mentioned valuation already, but it trades at a full turn discount to its historical average, which is incredibly unique in the context of the peer group. It sticks out like a sore thumb. And then finally, it's got a near-term catalyst, which is the transformative acquisition of the Plains Canadian NGL business. That transaction closes in March, and they're likely to follow up with a business update in April. And so that April event is what you typically expect following an acquisition, a consolidated growth outlook, deal synergies, organic capital opportunities. But we do see this event as unique. So first, they're going to give you likely a three-year growth outlook to 2028. And 2028 is an important year for Keyera as the KAPS pipeline expansion comes on, a third fractionator comes into service. These are highly contracted and significant contributors to growth. And then second, the Plains deal itself is just very accretive from a per share growth metric basis. And that just ultimately boosts the corporate growth rate. So ultimately, what do we expect from this event? An industry leading growth rate. We don't expect them to increase the dividend with the close of the transaction, but we do expect, just given that industry leading growth, that dividend growth over time will also be fairly attractive. In the near term, we expect them to focus on debt reduction. We do see them as a further consolidator. And I just reiterate that valuation discount given its strong institutional following.
It sounds like management there has a lot of confidence, a lot going on.
Yeah, you bet. Again, we recently marketed with management through several U.S. cities. And again, they feel very confident on the ability to close the transaction and what is available ahead.
Okay, let's move on to Pembina. And what are you liking there?
Yeah, our thesis for Pembina is actually very similar to Keyera. Pembina is the market leader in the same NGL space as Keyera, so it's a larger, more vertically integrated company, but all the same fundamentals apply. And so to further expand on fundamentals, producers in the NGL space are growing at 5% per year, in some cases higher. So again, similar to Keyera, Pembina also trades at a discount to its historical average, whereas many peers trade at a premium. And Pembina also has visibility to catalysts, so it checks all those same three boxes. The catalyst for Pembina is the sanctioning of new growth projects, which we expect in the near term, with Q3 results later this week, with their December business update, and their Q4 results early next year. And I'll give you two examples. First is $1 billion of conventional pipe projects that they've sort of disclosed already that would effectively allow for more volume from Northeast BC to flow to its fractionation hub at Redwater. And the second is a gas-fired power opportunity for Alberta's leading data center opportunity, which is backed by Meta. That's a $6 billion gross, $3 billion net capital project, which would come online in 2030. And it adds to projects that are already in flight, like Cedar LNG, that will come on in late 2028, and a fractionator that will come on in 2026. And ultimately, our view is that the market is paying a premium for growth visibility, and we see the next several updates from Pembina as a potential inflection point. And so again, strong balance sheet, spends within cash flow, and should support further dividend increases over time.
Is there optimism about more data centers coming into places like Alberta, which would then fuel companies like Pembina?
Yeah, I think so. I think Pembina has their hands full, though. There's certainly a lot of other players in that space, and I would expect that, again, we've got like $6 billion, $3 billion net is a significant opportunity for a company of Pembina's size.
Okay, TC Energy.
Yeah, so last pick of the day, TC is a pure play natural gas and power company. It's got direct exposure to the natural gas demand growth theme driven by, as you know, AI and LNG export capacity growth. Unlike our other picks today, it does trade at a premium, which we believe is warranted. TC, actually tomorrow morning, will host a mini investor day with its quarter. Typically, with the investor day, they give you a 3-year guide. We expect that, just given the visibility they have to growth, they'll extend that duration of growth. Potentially, we think the bogey is 5 years. They currently have a 5 to 7% growth CAGR. We think that remains intact over that time period. And they currently guide to $6 billion of capital spending per year. And based on their project pipeline, that's nearly fully allocated between now and the end of the decade. So clear visibility to long-term growth. And given continued demand for the types of projects that they're pursuing, we think it's possible that they could increase to $7 billion per year of spending in 2028, although we don't think that that's going to be a disclosure for tomorrow. And so, again, I would just reiterate, this is significant. I would note that there's just really no other companies in North American midstream that can offer you that percentage growth rate for such a long duration. We do expect tomorrow that they'll announce a couple new projects. And then on the power side, the last thing I wanted to leave you with, they own the Bruce Power asset. They own 48.4% of it. Bruce Site A and Site B are going through a major retrofit program, which extends the life of the asset for several decades, and that wraps up in 2032. And there's been increasingly positive chatter around Bruce Site C from the Ontario government, which we think would kick off right after that and would provide capital visibility to 2047. And again, I mentioned they own about half of it, but this would be a $50 billion project, $25 billion net to TC, and again, would extend the capital visibility out to 2047.
Wow.
And, they've increased the dividend every year for at least, 24, 25 years. They have an attractive yield, and we expect further growth is expected. Further growth in the dividend is expected.
All right, we'll wrap it up there. Aaron, thank you very much for joining us.